Greg Smith, MD at Global Commodities Ltd. Greg, many thanks for joining us. Good to see you as well. There you are, young man you are too. Now, soft is your major area. Tell us about food inflation for China, food prices, particularly for corn. I know you love talking about this. So where is it heading right now?
I do, mate. I do, mate. And thanks for having me, and good talking to you again, John. I think if we look at firstly soybeans, mate, because that's the one that's had the substantial rally this year. And that is something to keep an eye on relative to the rest of the food sector out there. If you think about China, it is consuming approximately 17% per annum consumption growth of soybeans. It is 28% of the world's consumption, and currently we've got the lowest inventory stocks to use ratio, John, in 48 years. Now, that was back in '65 when the crop production was 77% less than what it is now. And I'll finish with the statistics and get on to some other stuff. But when you think about the Chinese pig herd, for example, is now 690 million that need food, that is imported, and they're growing at 4.4% per annum. So in total, demand for Chinese food is growing 4 times quicker than the global population. So I think those sort of statistics give you the foundation of why I am bullish long term and indeed concerned about food becoming tight in countries that can least afford it to be tight.
So food shortages again, supply and demand, Greg, is the biggest concern. With that, of course, rising unemployment.
Exactly, mate. You know, we're in the perfect storm now. We need Goldilocks weather in the US, because if they don't get the sort of crop that they're expecting, and they're expecting Goldilocks weather, by the way, if they don't get that, we're going to see prices for grains, particularly soy, followed by corn maybe, because corn's now got the largest acreage to be planted since 1937, John. But there's a reason for all that, mate. As we have this global growth, the propensity to consume more food is growing, increasing GDP, increasing consumption of food. And we do not have enough inventory to give us the wriggle room that we've historically been comfortable with, hence higher prices and rapidly higher prices.
Let's go over if we can, Greg. You favour corn, but you also favour gold, coffee and natural gas. Not so much oil, though.
No, well, at the moment, the interesting thing in reverse order, John, oil, there's plenty of it in the US, not that much in Europe, hence the spread between WTI broadening against Brent. So there's less Brent than there is crude. I like natural gas because in a lot of places outside of the US, gas prices are going up. Again, US have got high net gas price inventories and hence low prices. When they start exporting that, which is in the next 18 months, 2 years, you'll see natural gas pick up. And I think as a long-term play, because I know you always say, what do you like as a long-term play? I like natural gas. Sugar, another one. Sugar's another one. Again, it's been sold off pretty hard. And the issue will be the weather patterns over South America. Anything like last year, we're in major trouble there. And finally, coffee is, from a technical perspective, John, it's sold off a lot. Inventories are more or less to market expectation, but again, any supply disruption, and that could be a good call option strategy, I think, coffee.
Greg, good to have you on the show again. Clearly, the food shortage is a big concern there, particularly for the soybeans and for corn. Greg Smith there joining us there from Singapore.